Welcome to PocketExperts.Solutions. This event is for educational purposes. The terms and conditions and the privacy policy apply as posted on the PocketExperts.Solutions website. Today's guest expert is Bob Grossman. Welcome, Bob.
Hey, Mark. How are you today?
Great. Bob's a partner in a regional CPA firm in Pittsburgh where he serves as a tax and business valuation services partner. He has a bachelor's degree in accounting and a master's of science degree in taxation. He's a CPA licensed in Pennsylvania and Ohio. He carries 4 business valuation credentials, including accredited senior appraiser with the American Society of Appraisers. He's a certified valuation analyst with the National Association of Certified Valuators and Analysts, and the accredited in business valuation issued by the American Society of CPAs. Over more than 40 years, Bob has worked expressly with small and medium-sized companies with private ownership, designing and implementing innovative strategic business and tax initiatives intended to provide operational and income tax advantages to the owner's benefit. Today, Bob, we're going to talk about COVID-19 business valuation issues. Any opening comments?
Well, only that's been rough. I think it's something that, none of us, either you or I, as kind of speakers on today's session or the members of the audience who are listening in, could have imagined 2 years ago that we would have a full year of interruption into a normal life environment, not only business, but everybody's personal life as well. And so we have found a great deal of consternation with respect to the length of time that the pandemic has been going on. And we've been trying to teach our client base and teach others how to maybe measure the performance of your managerial decisions in navigating through the COVID-19 pandemic, and how to measure how well you're doing in climbing back out of there. There's a lot of different thoughts and comments and commentators on how long it's going to take to fully recover and return to normal. We're obviously not there yet or anywhere close. So today we're going to talk a little bit about what does COVID-19 mean to the value of your business, both before it happened and then where's it at now and how can you bring it back?
Bob, how does the pandemic generally affect business valuation?
Well, it's interesting you should say that because we've seen the full range, Mark, in our firm, and I don't know what you've observed through your practice, but it's an interesting thing that there are certain businesses that have done exceedingly well. Most of those businesses are historically strong to begin with, but also the kind of businesses that were basically considered to be essential and at the same time open up doors for opportunities. That's not the case across the entire spectrum of businesses, though. And in those businesses, what I would say is just this year, companies that we've worked with in manufacturing, companies we've worked with in retail, such as auto dealerships, and companies that we've worked with, such as distribution of food products, malted beverages. We serve one of the largest malted beverage wholesalers in the region in Western Pennsylvania, and that company's done exceedingly well. We know by virtue of statistics that other alcohol rendering businesses, such as wineries and so forth, have also done exceedingly well. So those businesses have done great. On the other hand, certain industries, most specifically on a large scale, the airline and travel industries, of course, but on a smaller scale, the hospitality industries, and you're talking about entertainment facilities such as theaters and theater chains, as well as the kind of small playhouses you have in smaller cities, and restaurants have really taken it on the chin. So how does the pandemic generally affect the business? Well, that depends on your business and the issues that are there. I think the more open issue is what does the pandemic mean at this stage into the future? Because no matter what's occurred from early March, late February of 2020, when the World Health Organization and the CDC were declaring emergencies both internationally and nationally, is how things are going to proceed moving into 2021 as we move forward and try to get to the other end of this thing.
Yeah, Bob, I agree with you. And it's almost about trying to predict what the new normal is going to look like, right? I think the genie is out of the bottle in a lot of places where more and more people are using and looking at their homes in a different way. Do you agree? I mean, look at the Home Depots and the Lowe's and all those home improvement stores have gone through the roof with their sales. In addition to that, landscaping companies. I'm currently valuing a landscaping company, Bob, and they had outstanding sales because people are trying to beautify the places that they've been enhancing and staying around in a different view. What do you think?
Yeah, I couldn't agree more, Mark. And we just recently added to our portfolio of clients the landscaping company that does the work at my own personal residence. They had an incredible year. And the thought process, though, for them is that, they had this exceedingly huge year, which they've had in the past here and there due to certain dynamics in the economy. And every time that happened, the year after, looking at their historical records, it's been a lesser year. So, that's again going to depend on me and you, evaluators and owners, digging deep into their historical files and trying to understand how they've rebounded from other difficulties in prior years. But again, we're seeing the same thing you are, that a lot of companies have moved through 2020 in a very strong fashion that maybe aren't expecting to go 2021 at the same degree of growth that they've seen in the past.
Right. So it's a real analytical process and a discussion issue, not only
Sure.
based on benchmarking where you were, but then ultimately where was 2020, and then how is that going to rebound one way or the other, right? You might overstate 2020 as a result of going forward, and you may have considerably understated 2020 as well.
Sure. Absolutely.
Bob, there's one other company that I had, and it's worth noting because I think it fits for this discussion for our members. It's a company that did internet sales. And you would think internet sales are booming today, right? And things are going forward, and more people are buying from their home. So the Wayfairs and the Amazons and things are extremely high in sales, and they're developing a lot of product. But the thing you have to remember is those companies' supply chains and how they're being interacted with, right? The company that I'm talking about basically has, let's say, $20 million in inventory in the warehouses, but they're not able to replenish their inventories. So as they particularly sell down that inventory and that working capital, that's a limited amount of time because they can't replenish. So they might have outstanding sales for 2020. But what happens in 2021 when they're having a tough time resupplying their supply chain and refilling their warehouses, right? And there's a dynamic effect that's coming that people really haven't looked into yet. And I think that as you're a business owner, you really need to understand the business interruption, how it not only affects today, but tomorrow. What do you think?
Absolutely. I mean, that takes us into question two, Mark, and the question of valuation being a forward-looking concept. Then how do our listeners today, business owners, incorporate the effects of the pandemic into valuation? And that varies depending on whether you're using in the income approach, the market approach, or the cost asset approach, which we'll talk about in a moment. But you're absolutely correct. And I think historically, if you think about it in a simplistic fashion, if again you or I were to buy a share today of General Motors stock, we really don't care what it did yesterday. We only care what it's going to do in the future. And so this is a speculative process to some degree based on hopefully rational analysis and detailed financial assessment. But you're talking about more than the company operating that you have total control over. There's going to be a lot of things that business owners have previously not had to deal with in essence as it relates to the control of the operation going forward. And one of those are vendor payers. There's a number of things. Your biggest customers are going to have to be assessed for their financial strength and making sure that they're going to continue to be able to weather the storm and continue to buy your products. That's one of the things. On the flip side, with the payables are the vendors that you just mentioned and the suppliers. I mean, if you have supply chain issues, you're going to see business interruption going forward. I have a personal example of that. I ordered one of the new Corvettes, 18 months ago, and that factory for General Motors is constantly closed down because of a COVID impact at a plant in one state or in another country where parts are being supplied and they're just not able to get the supplies. So it stops the entire production run. Well, most of our clients, most people on the phone are not the size of General Motors. Nevertheless, they're going to run into similar issues. The other issue is employment. The face of employment is changing significantly, and how people are employed and where they're going to be employed from. We're seeing people in Western Pennsylvania, we're based in Pittsburgh, hiring people to work in their tax departments to live in Oklahoma City. They don't need to come to the office at all. And though we knew that was probably the case pre-COVID, going forward, there's no reason why you can't have an employee located in another jurisdiction or another area that brings that to the table. So that's an issue. So you're right. You have all of these different impacts coming in from assessing not only how you're doing things, but then how your customers are doing things and how they're going to get through, how your suppliers are doing things and how they're going to get through. What are the demands of the lenders and the capital providers of the company? Lots of challenges for sure. Much different than historically what we've seen.
I agree. And, I love what you had said, even about some of the cost analysis, right? And you're
Right.
taking a look at some of those overburdened costs, and people are going to look at a different way and say, maybe we can do this better. Maybe we don't need to have office space that's 20,000 square feet. Maybe we can get away with 10,000 square feet and have satellites, and a whole new business model might be there in the future. What do you think?
Yeah, and we're seeing that regularly. I mean, if you have someone that has a 3 or 4 year remaining lease, they don't have much flexibility. But people that are coming due in 12 to 18 months, 24 months, those companies, when you're doing your forward-looking assessments, your financial projections, I mean, you have an ability there to make some wholesale changes in what has been the historical practices of your company. And I think, everybody knows, I mean, the people on the phone that are business owners are smart people. Everybody knows that people are able to work remotely. But I think the creativity and the efficiencies that are still there post-pandemic from working remotely has basically fostered an acceleration of that remote working environment to the point that it's never going to go back, I don't believe.
Yeah.
To people paying $20 a square foot for 80,000 square feet when they can have all those people at their homes. It's never gonna go back.
Yeah. And I think part of that other piece is the effect of how it also changes the culture of the big cities, right? And the density of the population. You might have had sandwich places that were set up all across those particular areas in a highly dense populated area in those cities. And all of a sudden now most people are working from home. What happens to their population? How does that trickle down, right?
Yeah, and those businesses are closing down left and right. Unfortunately, those are the ones that are going to take the biggest hit. If you take a city like the one that we're based in, downtown Pittsburgh, Pennsylvania, it's a beautiful city with a lot of towers, but mostly what was there was not retail like a Chicago or New York, but mostly restaurants, and the flow of people from the offices to the restaurants is what kept everything going down there. Well, our tower has 24 floors. It's not a real large building, but they are seeing 10% of the occupants coming into the office on a regular basis, and that's it. So 90% of the people in that particular building on 24 floors, thousands of people literally, are able to work from home. So that's immediately going to dry up the the little custom sandwich and pizza shops that are all around our building, and they're going to be shutting down because they can't do it. You know, it's interesting, Mark. I know you're based in the Midwest in Chicago, but in Pittsburgh, and I live 30 miles east of the city, it doesn't seem normal, but it doesn't seem super abnormal, because you go to a Home Depot, you go to a Fridays for takeout food or something, you go to the supermarket and it's crowded. But when you go into the city, into downtown Pittsburgh, you can get out of your car and walk 3 blocks and not see another person. And
Yeah.
that's a dynamic change that is unbelievable.
Yeah, it is. And you start thinking about structures like parking garages and all of those different features that we have here in Chicago. And I don't
Yeah.
really see on how they're all going to make it, and what that's ultimately going to do with the dynamic structure of the cost of putting up those sky rises and funding those sky rises and doing all those different pieces. It's going to be a cultural change.
And that has to be factored into the valuations of all of our businesses going forward, because in one way or another, everyone is impacted.
Yeah, I think that's true. Let's take a look at number 3. Under an income approach to value, how does the economic effect of a pandemic factor into future projections and forecasts?
Well, the income approach is the most accurate method to value a company if you can get good quality information. And by that, I simply mean that you need to look at the history. You need to assess where the pandemic started to affect your business. And then you have to look forward post any particular date of valuation. We've been doing a lot of valuations for estate planning with the idea that the date of valuation is March 31st of 2020, because that was probably that period of time, or that date of valuation, in which uncertainty was the greatest. And that would obviously lead you to a higher risk rate under an income approach and a lower value. So that makes sense to do that. But when you look at the drop off, it was very sharp initially. So the question is, how's the recovery going to happen? And there are those people that talk about a V recovery, where we had the sharp drop and we're going to have the sharp bounce back up. That's one way to look at it. We have people that thought it was going to be a W, commentators, where you have a sharp drop down, a sharp back up, but then a second drop down, which might be where we're heading with the recent spike. This is December of 2020 in cases, and perhaps it's going to drop again and come back up again in the spring once the vaccine's distributed. That's another way of looking at it. And then there are yet people that think it's going to be more like a U-shaped recovery, that you had the sharp drop and a flat line for a while and then a recovery. And then there's the check mark type recovery, where you had the sharp drop and a gradual growth back up. And that latter one, the check mark type recovery, is the way that we kind of see it in our firm, though other people may have a different interpretation of where we're at in the marketplace. So we see a gradual recovery. And really, when you're using an income approach, you have to put together projections. And we're looking at 3 specific blocks of time, right? So if you're going to do a mid-year or early year 2020 valuation at the inception of the COVID pandemic, perhaps March 31st date of valuation, then you have all of 2020 that you have to factor in, right? Then you have to factor into your projections a recovery period. Some people are saying that's 2 to 3 years. So the 2021, 2022 projections, maybe the 2023 projections, have to incorporate these modifications. And hopefully by the time we get out to 2023, 2024 in the projection or forecast under the income approach, you're starting to see some level of normalcy. And I know right now it's conjecture and estimates at best, but we got to be striving for a return to normalcy at some level of production, even if you have a lower starting point. So obviously, when you had that sharp drop initially from the pandemic, for companies that experienced that, the recovery is going to be probably 2 to 5 years to get all the way back, and you're starting from a lower value. So from that perspective, I think the income approach captures the vendor issues that we spoke about earlier, the customer issues, the inventory supply issues, capital acquisition issues, cash flow planning issues. you can incorporate all that type of financial analysis into that recovery period projections, hoping to get to the end of a discrete or specific projection period before you start to go back to normal growth patterns. On the risk side of that number, on the income approach, because there's always a numerator, which is the expected future cash flow, and a denominator, which is the risk rate. In determining the denominator, you may be able to factor in certain areas of your projections and calculations, different risk rates for steps that you're able to take as a management group to reduce risk, which will increase value going forward. So I like the income approach, even in light of the unknowns associated with the pandemic, Mark, because it allows us to basically customize it to the very specific circumstances of any company we might be valuing.
You know, Bob, what we have here in number 4, we talk about the risk rate that you brought in, and I'd just like to comment a little bit on that and see your opinion.
Sure.
You know, we're using a discounted cash flow methodology these days, using the historical as a benchmark, and I don't expect our members to really understand what that means other than this. We have a projection. We're trying to figure out what it's going to look like till we get to a new normal, right? And that's a very difficult thing to do based on historical information and predictions and discussions and information that we then process. It's important for the business owner to understand that as we predict in uncertain times, like in 2020, that risk is much higher than it might be, say, in 2021, that we have now a little bit more understanding, right? And then 2022, where we think we get back to some type of new normal with this pretty much behind us, or we hope that it's behind us, right? And as we bring into those different scenarios, the more that we go out into the future, the more adjustment we need to have the risk for increase or decrease in our comfort level to those projections. What do you think?
Yeah, you're absolutely dead on. I mean, that is the issue, right? If you take a normal pre-COVID risk rate of maybe 20%, which equates to a 5 times multiple, would not be extreme one direction or another from a valuation standpoint. You would expect that would change for the worst in this 20 period post-COVID to the end of the year. And I agree with you strongly that you'll see that premium that's being added to the risk rate for the balance of 2020 and 2021 starting to cure off as steps are taken to restore the economy to the way it was beforehand, before the COVID. You know, the problem with that, and you talked about the difficulty, and you're absolutely right, you know, totally unrelated to anybody attending the call today or in the webinar today, is things like the distribution of the vaccine, the effectiveness of the vaccine, the actual, in the short term, the economic effects of the close downs that seem to be manifesting throughout the country in the month of December 2020, and probably will have some effect into the spring. All of those things are going to have some short-term to mid-term effect on not only the benefit streams, the numerators in our calculations, but also on those risk rates that you're talking about.
Yeah. And, you know, just to put it into common terms, it's kind of like common sense. If you were going to buy a business today, right, and you were uncertain as to what the traffic pattern is going to be, or whether or not everybody's going to come back to the density that once was, you know, would you pay as much money for that company than if it did before all this started, right? And you knew that it was going to be X% of volume every single day, right? Where now you don't know. It just makes common sense you would pay less. That is due to the increase in risk and then the adjustments to your benefit stream, right?
Sure, absolutely.
So let's take a look now, number 5, and this is kind of one of my bugs that I get. It's under the market approach evaluation. How does the economic effect of the pandemic factor into the use of the publicly traded guideline methods or even transaction methods of valuation?
Yeah, again, we're not trying to make experts of the people listening in today, but if you think about the market approach, and I know I said I like the income approach to valuation because it offers an opportunity to really tighten tighten down the estimate of value on the specific expected cash flows of the company. But the market approach as well is a very sound methodology if you're able to apply it correctly and draw the proper comparisons and gain what we would call in the business valuation community sufficient similarity between those companies you're using as proxies to your company itself. So the two methods that are most often employed as we look at public stock market information and we try to draw similarities between companies trading on the stock market and then develop multiples from that information and apply it to your company's information to come up with a proxy for value. On the transaction method, the completed transaction method, there we're looking at deals that have been done through data collected by database type companies. And we try to identify companies of sufficient similarity to your company. And then we use, again, the multiples developed from those transactions to try to basically put an estimated value on your company. Now, again, there's a lot of nuances to those two methodologies, but the likability factor associated with those is that you bring in real outside market information, if they're applied correctly, to your company. The problem is most of that historical data that is used from the marketplace transactions, not all of it, but most of it is pre-COVID. So now you have a problem with taking those multiples and you have to adjust those multiples for the effect of the COVID in the intervening period between the date of the data and the date of valuation that you might want to determine value. So it becomes very tricky. The other issue that's of problem is the publicly traded companies have different strengths and weaknesses generally than privately held companies. And so there's an issue there as well as to whether or not you can use those multiples straight up. For sure, we know that pre-COVID data from either method is subject to adjustment if we're going to apply it post-COVID, no question.
No question. And Bob, one of the things that's really important too, and why I agree with you, I love the income approach way more than I do the market approach for all of that specific detailed information that we can obtain. But the market approach, something for our business owners to understand and why we think that it's important to understand not only the issues that took place around the transaction, but in and of themselves, the identity of the actual business that we're talking about. Here's a perfect example of what I'm talking about. Let's say we had two identical sandwich shops, right? One happened to be in the basement of your building, and any given day could populate more than enough activity for that business to succeed on a very detailed, successful business, almost to the point I'm sure that you could almost identify exactly how much they were going to generate in sales on a daily basis because people are creatures of habit, right?
Right.
You go through that process, you take that same exact store and you put it in the middle of the suburbia inside of Pittsburgh, that if nothing else has increased in size, more so than not, that their volume has probably increased. Identical store, identical product line, and identical information. Due to this particular pandemic, those two entities are extremely different in value, are they not?
Oh, yeah, absolutely. And you're right.
And it's all based on the outside circumstances, based on what has happened under this particular pandemic.
It's true. The other thing I think on the publicly traded guideline method that's troublesome to me, even post-pandemic data, is I like to think I'm a smart guy, and I've studied financial markets for years and years and years as part of the valuation training that I've had and what I needed to do valuations. But it's difficult for me to really understand where the market is today, setting new records each day. And today, this December 4th, I mean, the market's up another 250 points. It doesn't seem, it's almost counterintuitive to the problems and the risk that we face. And it's hard to tell whether that numbers that are coming out of that particular method, the publicly completed transaction method, or not that, the guideline company method, excuse me, is giving us accurate data, or if it's building a bubble that will burst at some point. I think if you were to extrapolate, even if you could find companies in a publicly traded company method that are sufficiently similar to the company that you're valuing, to our listeners' companies, the question is, do you take that multiple in November, December of 2020 and apply that to a privately held enterprise without significant adjustment, not understanding what's really propping up the very high market multiples? Don't get me wrong, I love it because that helps my 401k and my retirement. But on the other hand, it's also very worrisome to think that the market just keeps moving up and up no matter what. And I wonder how much of that is market mania and how much of that is fostered in sound economics. And that's part of the issue with the publicly traded method as well.
Yeah, and Bob, one of the things that's really important to understand is in question number 6, we talked about the completed transaction already. So I'm going to ask you about that since you brought up the market approach and the market going to 30 of all places, right? Who would have thought in this pandemic? But when you look at the inside of that number, just like you have to do for everything, the mix within that has changed, right? The factors in the industries that have gone up and down have changed. If you looked at the Carnival cruise lines and all of the cruise industries and those publicly traded cruise lines, they were down from $60 a share down to $20 a share, right? And they're still hovering around $20 a share. And the airline industries and all the entertainments, and you take a look at, all of the Vegas properties and all the Hilton properties and it just, all of those particular segments, the bars and the industries that are publicly traded, that entertainment industry has taken a severe hit. And then you take a look at the companies that do technology for internet, such as Zoom, for example, that have gone through and it's up 400%, as it continues to go forward. And you take a look at some of the different, pharmaceutical companies like Pfizer and what have you that have put together the pandemic information and the vaccine coming forward and their growth spurts and their potential growth that offsets some of that, right? And as a result, continues to rise as a result of a different mix within that market. And
I think you're right. I mean, that's astounding to me that, one person's bad news is another person's great news. And, just to build off what you're saying, I don't know if it was Zoom or GoToMeeting or which one, but I know recently, when the vaccine was announced, the market went up, crazily. But beyond that, the stock of Zoom dropped precipitously as well because people assume you get the vaccine, you won't need as much Zoom.
Right.
And so it's an interesting thing. You're right. It's a dichotomy of various dynamics that we've not seen in the past.
Yeah, and it's all within that market. No different than, the same exact store at different locations determine the value significantly. It's a different world that we're kind of living in a little bit now because those effects have been really accelerated to levels we've never seen in a drastic way.
That's right.
Let's take a look at our next question. Under the cost asset approach to valuations, how does the economic effect of the pandemic factor into the use of the net asset methodology evaluation?
Well, I think first, people on today's webinar have to understand and appreciate that generally we in the business valuation community are not using the cost asset approach to value operating companies, but more often holding companies that simply hold assets. Now, that being said, you can obviously use different kinds of methods to determine the value of the intangible value or the goodwill of an operating company under a cost asset method, but they're not often perceived as being as reliable as using a simple income approach or market approach methodology. So if you think about the cost asset approach in conjunction with the valuation of the underlying assets, the holding company assets, then you have to look to the nature of the assets and the kind of assets that they are. We had a timber company with thousands of acres of timber that's used in the pine and making framing for houses, and housing starts are up in the economy. Housing is pretty strong right now. That's one of the things pricing up the public stock markets. And so that company was okay, because it had those kind of assets. Now you have other companies that might hold, you know, 6 commercial pieces of real estate, and out of those 6, 4 are retail uh, commercial properties. As you talked about earlier, Mark, that presents a major problem and probably a huge value detriment. So appraisals of the underlying assets are generally called for in conjunction with holding companies. And so you have to look at those particular entities and what the cash flows are going to be like on each commercial building from an appraiser standpoint to fully understand what the impact of that is on your cost asset method determination of value. Most certainly, most commercial real estate properties are going to drop in value, simply because of the things we talked about earlier in today's conversation, that people are moving away from the towers and away from the commercial buildings and even away from the small retail shops, the commercial pizza shops and restaurants, et cetera. So the cost estimate approach, I don't think we'll see that being used a lot again on the operational front. But I would say in most of those cases, the operational properties or the properties are being held by these holding companies where the cost estimate approach is appropriate are going to see drops in value.
Bob, it's amazing to me when we say that about the commercial side. Think about the residential side too. And home inventory is almost non-existent due to the low interest rates that we currently have, and those factors of more people spending more time in their homes. It's amazing to me on how we're going to see the shift going forward in the design of new homes and what people are going to want. Is it going to have in that built-in office space available? Is it going to have it where you could work from home as part of the design of the new house? With soundproofing and all the other things that come into play with your own technology built in. Is that going to be a selling point? Is that going to be something of the future that we're looking at? It's kind of an interesting thing too, because that could shift the entire concept of the residential market as well, don't you think?
Oh yeah, I agree. I have a daughter that's building a house right now. I mean, it's a starter home. It costs 9 times the cost of the starter home that my wife and I bought back when we were there. I think I read an article not long ago, I believe in the Wall Street Journal, where houses, building companies, especially the big companies that build hundreds of homes, got rid of the lower cost homes because they can afford to do that. Because as you said, the interest rates are making bigger homes more affordable. So that's changing, already starting to change the market substantially, and probably pre-COVID, but even more so post-COVID. I mean, where she's building a house is a plan of 500 homes. There's got to be 50 or 60 going up at any moment, it's been that way all summer and in the fall and winter now. It's shocking to me, but it's incredible. But it's happening. You're right, and I'm sure this is just one small microcosm of what's happening around the country.
And Bob, the other part of this is that a lot of people aren't really thinking about, but need to when they start assessing their balance sheets and their working capital and all those kinds of issues. Right now, inflation is virtually minimal or non-existent, right? And
Yes.
what happens if those interest rates rise? What happens to the debt and the cost of the debt when we're in trillions and spending trillions and trillions of dollars? What is that picture going to look like? And then how are we going to be able to subsidize that event, right? And how is that going to impact the operations and our forecasting going forward? Big deal, right?
Well, oh yeah, you're right. I mean, what that's doing is, I mean, every valuation, as you know, Mark, basically includes kind of an assessment of how the overall national market affects, your particular company, and that's a big unknown. I mean, if the banks start paying higher interest rates than they're charging for the mortgages already, I mean, and those have never been lower, 2.5, 2.75% mortgages for 30 years. It's unbelievable. So you're right. That could have a substantial effect later, as well as, other unknowns are in all of these 3 methodologies. Is obviously we have the COVID issues, pre-COVID. We have the second occurrence issues to try to understand. We have the vaccine effectiveness and distribution to try to understand. And then you have the overall effect of the national and your regional economies, depending on how the company's structured that you're operating, where they operate at, to see how they affect your company going forward. All of these things are beyond the control of the management and the ownership of the companies that we're valuing, but they have to be factored into the process to get us a proper numerator and a proper risk rate.
And that's one of the reasons why when we're valuing companies that we look at the economic forecast, we look at the industry forecast and what's happening within that particular industry to try to help us determine what those benefit streams and those cash flows are going to look like, right?
Absolutely. Absolutely.
We already touched on the economic effect and the benefit stream. Let's tie that economic effect into determinations of discounts for lack of marketability. What do you think?
Yeah, I think the issue of marketability is more substantial than it was pre-COVID. And that's simply because, again, the unknown in the future. We know that most of these privately held business interests do not have a ready market in which they can be converted into cash. That's a given and a very common phenomenon or characteristic of privately held ownership interests in businesses. But I think it's worsened with respect to marketability. On the one front, one of the things that serves to enhance marketability and reduce any discounts for lack of marketability is a historically steady stream of cash flow distributions to the owners. If that's going to continue to happen and you're going to continue to do that, and you have the actual fiscal capability to do that in light of the COVID pandemic effects on your business, then there probably isn't much movement on the marketability discount from what it might have been in the past. But going forward, I think that's a real question mark. And if it's not going to be the same as it is in the past, then you're obviously going to have a higher discount for lack of marketability, Mark.
What about discounts for lack of control?
You know, I'd like to say I have a very definitive answer on that, but I don't. There's a question in the marketplace or in the business valuation community as to whether discounts for lack of control are influenced by the pandemic or not. And I'm inclined to think that it may be impacted, but not materially. And the reason for that is most of the additional risk that's associated with the pandemic, in my professional opinion, has to do with the marketability. And so that will be handled in conjunction with looking at future expected cash flows, risk rates, or the marketability discount. And so if you do happen to have a valuation or you have an ownership interest, if you're listening on today's webinar, of 20 or 25% non-controlling minority ownership interest, there probably isn't a lot of additional control risk that has to be considered in conjunction with the valuation post-pandemic.
I think, though, for our business owners, let me float this by you, Bob, and get your reaction. You know, when you think about lack of control or control, it comes down to how the controlling member of a business, and I'm assuming that's a lot of the business owners that we have on this call, as you listen to these particular comments, how do they react to the benefit streams and the things that are happening around them from a risk perspective to maximize and deal with the cash flows and the working cash flows issues and the burn rates and the ability to survive this process going forward, and the minority shareholders just to be able to sit back and do nothing as a result of that? How do you think that relationship works?
Yeah, I think that's a real issue, Mark. I would agree with you. I guess my general thought is what we've talked about a lot in my firm is that it really has to result in a higher discount for lack of marketability, because you are exposed to the initiatives of the controlling owners, whether you like it or not. So you're stuck in that less than controlling environment where there's a control shareholder making decisions, and whether that management group or that controlling shareholder is knowledgeable and understands what's going on, and whether they're inept, whether they just make mistakes. you're stuck with whatever the outcome as a minority owner. So I think that makes that ownership interest much less marketable, and it does add to your investment risk. But I think it, for my personal purposes, again, we would boost up the marketability discount to try to assimilate that.
Yeah, I mean, it's going to be somewhere, right?
Oh yeah, absolutely, no question.
How does one avoid duplication of the economic effects of the pandemic in different parts of the business valuation process? It's funny how this kind of followed right into it, didn't it?
Yeah, I mean, this is exactly what your question was for the most part. I mean, if you think about valuation and risk assessment, and if the people on the webinar today think about uh, a simple income approach calculation, $10,000 in future economic benefits, generally cash flows, as you said, Mark, a risk rate of 20%, a multiple of 5 times. So you would divide the 10,000 by the 20%, and that would get you a $50,000 value in that example. And then you would take a discount at the bottom for lack of control and a discount for lack of marketability. Let's just say the combination of the two is 25%. And so that gets you a net value at the end of the day of 37.5 on a non-controlling, non-marketable basis. So in that simple example, I would ask folks on the webinar to think about, where the risk is. Well, the risk could be in the determination of that 10,000. It could also be the 10,000 could have no risk in it, and you could have your risk incorporated in the 20% risk rate, or those two could stay stable, and you could have a bigger marketability discount to accomplish that at the bottom. So just so the listeners understand, again, we're not trying to make them valuation specialists, but they have to be aware that there are multiple places to put risk. And you want to make sure you're not duplicating that risk. So when you're speaking to your valuation advisor, your accountants, controllers, and legal advisors, you need to make sure that people are being careful to consider that risk in the proper place without overlapping it. It's not always easy to completely eliminate an overlap or a double dip on risk assessment, but you need to do that to get the best answer you can for you in managing your companies.
Bob, how would the economic initiatives enacted by the government legislation, such as forgiveness of loans under the Paycheck Protection Program, be incorporated into the business valuation process, even if at all?
Yeah, that's a point of discussion that's been broadly discussed this year. Almost every American company that had any kind of quality management or advisors have sought monies under the Paycheck Protection Program. And under that program, those loans are ultimately going to be forgiven. We see that as a one-time occurrence. So the loan itself, if there's money left, and right now that loan is subject to tax, not the loan forgiveness itself, but the fact that you can't deduct the deductions, the payroll that were paid and the expenses that was paid with those proceeds on your federal tax return, that you'll have a tax liability associated with the loss of those deductions. So the wash or the net of the two, the loan proceeds minus the tax cost, has to be a number that's considered as kind of a non-operating item in the course of your valuation. Now, you did have those same costs incorporated in there that you always did. You just paid for them with free government dollars. So when you're doing your projections in the valuation process, they should continue to include those costs, and you should be continuing to incur the revenue that goes into there. It is amazing how impactful those PPP loans were this year for many small businesses, and kept not only kept them afloat, but kept all those employees employed in jobs. So it needs to be considered, but it's not going to be part of the operational items because it's not expected to be incurred again in the future. So you need to take care to make sure that that's treated properly in conjunction with any valuation. If there are dollars available in your business, not because of PPP loans, because theoretically you spent all those PPP proceeds on qualifying expenses to qualify for forgiveness, but that should have saved you a like amount of cash flow that you would have had to pay those costs anyway. And so if your revenue didn't change at all, and I'm not suggesting that's the case for anyone, but if it didn't, the assumption would be you'd be sitting on a like kind of amount of cash on which you have to write out that tax liability. And that would go into your non-operating excess working capital, whatever, as a one-time asset at the end of your valuation.
Bob, as an overview here, what do you think is the most important consideration in managing value in the COVID-19 pandemic era?
Yeah, I've read a lot on this topic, and I have a lot of thoughts on it. I mean, the first thing that has to be focused upon is survival, right? And I know that there's a number of PocketExperts.Solutions programs tailored to helping people understand just how to understand where their cash flows are, steps they can take to continue to preserve cash flow and generate cash flow going forward. I think that's important. But I think it's also important to get a global understanding of everybody that's involved in your business. And generally in business lingo, business school lingo, like Mark and I went through many, many years ago, they refer to these people as stakeholders, not stockholders, but stakeholders. And so a stakeholder in your business includes your customers, right? Because if you can go out and make a decision and you can say, I'm going to bill 25% more than my competitor for this product. Your customers will pay that for a short time, but it won't take long until the market adjusts to the idea that you're overcharging them and they're going to shift providers. Same thing with vendors. You can say, I'm going to negotiate hard with the vendors and I'm going to, try to screw them out of another quarter on a dollar or whatever and make some adjustment there. Or a union contract when you're negotiating with your employees, save a buck there. At the end of the day, the market meshes all of those items out. And so if you're underpaying your employees because you were able to successfully hard-nose your way through, a pay raise period or something, ultimately the employee's just going to leave and go somewhere else. All of those kind of stakeholders, have an interest in your business doing well, but you have to understand as a management group, as an owner group, what those stakeholders expect, how that balances with what you get as the final stakeholder, the stockholders, the equity holders. And if you can understand that to the nth degree, you'll have a better management group and you'll make decisions that are more insightful and more focused on value preservation and growth going forward, even coming out of something like this pandemic.
Outstanding. Well, this has been a great discussion, Bob. I think we've given our members a lot to think about. And one of the most important is that they also control the value of their company through how they act through this particular pandemic process. And can ultimately affect the value of their company significantly through the benefit stream and the risk associated with their companies. Do you have any closing comments, Bob?
Only that, value is the metric, and people need to understand and appreciate that. I think a lot of business owners haven't been trained properly, probably because we as CPAs haven't really been trained properly, and most of our focus has always been on year-to-year measurement of performance. And that's important, there's no question. But I think at the end of the day, it's value and value enhancement and value growth that should be the goal of any business owner, and that he or she should understand how to manage for value growth to take their business from, what it's worth today. I have no idea, $1 million, for example, and how to move that to $20 million at the point of exit. And that takes a different kind of assessment than understanding where the cash flow is this year. Certainly, cash flow, net income, all important elements, even to the valuation process. But managing for value is still something different and something you should be thinking about all the time, as Mark, as you indicated earlier, that we should be trying to control the value of our businesses.
Great, Bob. Well, thank you so much. It was a great discussion, Bob.
Oh, you're welcome. I'm pleased to have been here.
If you've enjoyed today's session, please feel free to explore other educational opportunities as presented by Bob or any other member of our national team of experts on PocketExperts.Solutions. Should you have a need for further information on today's topic, or if you require assistance to develop and implement a solution to this and/or other related issues affecting you and/or your business, we suggest you visit with your personal and business coach and advisor who can direct you on the next steps. If you do not have a personal or business coach or advisor, we invite you to contact Bob on his particular profile within the PocketExperts.Solutions website. As always, we thank you for joining us today and spending your valuable time with us. We look forward to seeing you again soon as you move forward to your journey on achieving your goals.